With the recent presidential election, a lot of investors are worried about how the outcome of the election might impact on their investments. Well, in this video, we will be looking at the relationship between presidential elections and the stock market returns. Looking first at the short-term effects of election results on stock market returns, Ben Felix, an asset manager, did a study comparing the returns for the 12 months starting in November of election years and non-election years from 1926 through to 2019. Ben found, on average, the 12 months following an election year, it has delivered slightly lower returns at 10.6% than all other 12-month periods starting in November, which delivered returns of 11.9%. Now, it's worth mentioning that when thinking about whether an election is going to be good or bad for the economy and stock market in the short run, is that we all tend to have our own political biases, and this influences how we view the world. So, for instance, if we favour a certain political party, we tend to think of their win as good for the economy and stock market. Conversely, if that party loses, we tend to think that it's not so good for the economy and the stock market. This was studied in a 2012 paper titled Political Climate Optimism and Investment Decisions. The author found that individuals tend to perceive the market as being less risky when their political party is in power. As the market aggregates the expectations of all participants, and not just those aligned with a given political view, we don't expect to see any major stock market events to arise directly from election results, and that's what the data shows. Stock market volatility, on the other hand, might increase around elections, especially around tight elections. In a 2019 paper titled With Greater Uncertainty Comes Greater Volatility, the author found that stock market volatility seems to be linked to both economic policy uncertainty and the business cycle. So far, we have seen that stock market returns don't tend to be dramatically affected by election outcomes, but stock market volatility may increase with the type of economic policy uncertainty that may arise from tight elections. A more interesting question might be how the political party in power might affect the stock market returns throughout the duration of their presidential term. Forgetting about the short-term volatility, is there a longer-term difference in the US stock market outcomes related to politics? The short answer is yes, there is. In a 2003 paper titled Presidential Puzzle, Political Cycles and the Stock Market, the authors Santa Clara and Volkanov examined the stock market through political cycles from 1927 through to the end of 1998. The excess returns of the US stock market over the 3 months Treasury bill was on average 9% higher under Democrats than it was under Republicans. Before jumping to the conclusion that there is a relationship between positive stock market returns and the Democratic leadership, there is a more theoretically consistent explanation to consider. In a 2017 paper titled Political Cycles and Stock Returns, the authors Pastor and Veronica updated and responded to the ideas in the Presidential Puzzle paper. Santa Clara and Volkanov found that the stock market delivered much higher returns on average when the Democrats were in power. Updating the analysis of stock returns under Democratic and Republican leadership from 1927 through to the end of 2015, they found that the excess returns under Democrats were 11% higher per year than it was under Republicans for the same period. That said, a persistent stock market performance difference based on political leadership poses a theoretical problem. For larger stock returns to persist under Democratic leadership based on Democratic policy initiatives, the market would need to be consistently underestimating their positive benefits. Pastor and Veronica instead suggest an alternative explanation that aligns with a rational stock market. So they say, it is not the Democratic policy that results in a positive excess return, but it is the timing of when the Democrats have been elected. They developed a model of political cycles driven by time-varying risk aversions. When risk aversion is high, such as in times of economic crisis, voters tend to elect Democratic presidents because they demand more social insurance. When risk aversion is low, people tend to vote Republican because they want to take more business risk. In the model, risk aversion is higher under Democrats, resulting in a higher equity risk premium when Democrats are elected. and therefore a higher average return. So, to summarize, for me there are 3 key points. The first is, stock markets tend to deliver much higher returns when Democrats are in power. Second, when risk aversion is high, such as in times of economic crisis, like the one we're currently in with COVID-19, people tend to elect Democrats for presidency. Case in point with Joe Biden. Thirdly, and finally, both the higher returns and the Democratic presidency are caused by the high risk aversion leading to the election, which I find most interesting. Well, hopefully you found this video of some use, and until next time, have a good one.